Welcome and greetings to the next session here on day 2 of the ACT's Festival of Treasury Transformation. In this session, we're going to be talking about the use of SaaS platforms to deploy multi-funder working capital solutions for corporate treasurers. I'm pleased I got that one out. Yeah, that's quite a mouthful. Anyway, today I think we've got a great panel here. Just to introduce myself, my name is Brian Shanahan. I'm moderating this session. My day job is I'm the CEO of Informita, and we're a working capital and procurement consultancy. And today I've got Merisa, Frederic, Richard, and Maurice here to share the limelight, or the lowlights, as it were. And we're going to get on with the introduction. Shall I start with you, Maurice?
Sure. Oh, it's great to be here. So I'm Maurice Benisty, and I run the commercial function at Demica, and I've done so for the past 3 years.
Richard?
Hi, I am Group Treasurer at Nomad Foods, and I guess of interest to this particular panel is that we're currently about to go live on a multi-funder supply chain finance program.
Merisa?
Hi, everyone. I know it's not a competition, but I feel out of the whole bunch, I feel I've got the best job. So what I do and what I've been doing for the last year and a half is I run a team that looks at innovation in the trade space, innovation and customer journey. And I spent a lot of time listening to customers being corporates hopefully such as yourselves who are on the session. And I spent a lot of time listening to customers talk about their pain points, their challenges, especially in the working capital space. So probably of value for the panel is just to explain Lloyds Bank and working capital. We provide solutions where we're the sole funder, and we're also run programs where we offer multiple funders. We are funders to platform-led programs, to other bank-led programs, buyer and supplier centric. And I've also spent a couple years time working with corporates in the past to implement and grow their supply chain finance programs. So I'm really looking forward to the session.
And Frederic?
Hi everyone, my name is Frederic Bourgeois. I'm the CEO for Coface in the UK and Ireland. I've been in this function for 8 years now, and prior to that I was working at the head office or in capital markets. So my background is mostly capital markets and reinsurance, and then I shifted to primary credit insurance.
Okay, just before we get into our discussion, just a few housekeeping points for everybody. You may be aware that there's an online app which you can use on your phone or on a desktop. That's the means to submit questions and answers, which we'll get to later. So the more people ask and the more popular those questions are, the more likely that I will put them in front of the panel later in the session. The second thing is, if it's for some reason that you have to drop out at some point, don't worry about it. The session's being recorded, so you can go back to that for a good time afterwards. And the last point is, there is also a separate discussion forum. So please get active, be vocal, or at least in a virtual sense, and we'll take it from there. Okay, without any further ado, Maurice, I'm going to put you on the spot with the very first question that we've got here. You know, we're in the middle of this pandemic at the moment, yeah? How do you see that that's affecting investment in the kind of technology that's required to do supply chain finance programs?
Sure. So I think the, this really kind of came into focus as the pandemic started, because we saw the business interruption that everyone saw. All of our team kind of started working from home, and we looked at our pipeline, which is predominantly kind of SaaS led implementations of technology solutions in the working capital space. So we provide banks with the ability to white label our platform, and we also provide corporates with the ability to use it. And the question was, well, what happens now? Do sales processes get stuck? Do people put investment on hold during all of this uncertainty? So we kind of held our breath for a little bit, but it didn't take long before we saw, some really surprising trends. So through Q2, the number of RFPs that we've seen has doubled relative to Q1, which we certainly weren't expecting. So the interest in the product and the interest in the platform has increased as people start thinking through, kind of priorities and how they can leverage technology, I think, for more efficiency and for automation. And we saw existing transactions close and go into implementation. So I think what we've seen is that even with everybody working from home, the ability to convert and to progress has been proven out, which was not a known at the beginning, and the need to leverage technology to improve processes, customer experience. If it was there before, it's still there, and it's accelerating, which obviously has been gratifying for our business. And I guess the other thing I'd point to, we've started looking at the platform data that we have. So we process over 90 billion euros of sales. So we have kind of daily feeds that are providing us with with almost real-time information on how sales is progressing. We've started looking at it sector by sector. And in the technology space, broadly defined, relative to the beginning of the year, sales volumes are significantly up from our customers, and those are our customers selling technology solutions, up 75% on January levels. So what we again thought might be a temporary blip as sales were brought forward in March and April, when people were kind of adapting to the need to work from home and so on, we've actually seen it not at the same level, but we've seen it continue. So it's starting to give us a real some real confidence in now how we invest as a company, because our customers are continuing to invest.
I just wonder on that point, Maurice, are you seeing people who maybe would have made a decision next year to implement something bring that decision forward, or is it people who may not have been actively considering who've now changed their mind over 3 or 4 months to get this done quickly?
It's both. I think the most important thing for us was, were the people we were engaged with and quite advanced with going to complete because of uncertainty, and that's really carried on as it was. It didn't accelerate or decelerate. It just continued, which given the challenges was significant for us. We've certainly seen an increase in inquiry from new sources. It's difficult to tell whether they would have asked anyway, but when you look at the level of interest and the number of RFPs issued, it indicates that people are bringing forward their plans relative to where they are. And to be fair, we've also seen, particularly on the corporate side, RFPs that were launched in Q1 where they said, look, it's just not a priority, we're going to put it on hold. So it's not uniformly positive. And obviously, kind of volumes are down as people are sort of spending less. So there's a mix of activity. I don't want to give rise to an overly rosy picture, but those underlying themes of investment are continuing.
Okay. And Merisa, what are you seeing from your perspective?
Maybe I'll just add to what Maurice is saying. From my side, I work really closely with the team in transformation that deliver projects. So budget is key. And I definitely have seen that investment hasn't gone down in tech for us in the trade space. What's really happened for us is reprioritization, which I think is very healthy. It's something we should do all the time. I mentioned we're constantly listening to clients, their pain points. Well, their pain points have definitely changed over the past couple of months, and we're able to pivot from that. So we've been able to invalidate some projects and put them aside, which we celebrate. It's great when something we tried out maybe is not the best thing, but it's not the right time or so on. We've parked a couple of projects that way, and we've definitely accelerated others, and that's really good. So when we're going through the reprioritization in terms of investment in tech that my team are doing, we challenge ourselves, especially in this time frame. What can you do in 90 days, but in 60 days? And what about 30 days? And then why can't we do it in 30 days? And when you start asking those questions, you start to realize there's a lot of kind of stuff that's in the process that actually, do we really need it there? And we start to question it. And it's almost been a blessing that we've been able to, in this time, put those things aside and just accelerate things, do the right things for our customers, for delivering better solutions. And we have to look forward and make sure that it's something that we have in place, and we don't forget that even as we hopefully move outside of this. I think Richard had something to say.
So that was me putting my hand up. All I was going to say, Brian, was I think we're also going to look at the purpose of kind of working capital solutions. So I mean, here the pandemic has brought out some really big challenges in both the kind of the supply chain, as people's kind of suppliers are constrained of cash. There might be some informal kind of asks around early payment of invoices on either buy or sell side. But also, access to capital in general has become a little bit more kind of constrained, or cost of funds has increased. So here, I think people, maybe they've kind of looked at supply chain finance or receivables discounting or else as a complement to existing, funding sources, but actually now it might be a little bit more of a priority to them in addition to supporting some of the direct and indirect supply chains.
Okay, and just from your perspective, Richard, I mean, I know you're in the middle of implementing a solution right now.
Yeah.
One of the things that always interests me is what's the corporate motivation for doing this? Just wondering what that is from your perspective.
I think there's a bunch of things, right? I think, and this probably comes back to the point that we kind of addressed in the first question, being if you look at it on the face of it from a corporate perspective, these are opportunities to complement your existing capital structure with access to funds, at a comparable or a cheaper cost of funding. There is the potential to improve your own kind of working capital. But I think importantly in these kind of times, actually support of your direct and indirect supply chain should not be underestimated as being the primary goal, actually. In terms of your business disruption, is it going to be more or less disrupted by access to kind of capital? Well, that probably depends on who you are. But actually, is it going to be disrupted by some of your suppliers becoming more constrained because they don't have access to liquidity? And the answer there is very fundamentally yes. So I think from a corporate perspective, or ours particularly, there's a bunch of different motivations, but I think what's prompting perhaps more RFPs or more interest into Maurice's and Marisa's space is actually some of the challenges that this pandemic's actually brought out, which is, access to kind of cash throughout that supply chain journey.
Yes, Merisa.
I just wanted to add on to that, because something that's come out in discussions, and you probably have seen lots of surveys and stats, is a lot of the disruptions are happening not just with the tier one, the direct suppliers of corporates, but it goes down to tier two and below. I think the stat is more than 40% of that. And there's a lot of focus now, and correct me if I'm not, Richard, on, what is it within supply chains that I can't see? Show me what I don't know. Are there any early warning indicators? And I think a key driver that's coming out is it's not just about my working capital if I'm going to launch a program. And I want to make sure my supply chain is stable. And does my suppliers, how are they doing with their suppliers as well? Because a shock there could impact me. What do you think about that?
No, I agree. I mean, I kind of talk about kind of direct and indirect supply chain being those kind of tier two, tier three kind of suppliers. I think it's kind of incumbent on all of us, right? We've kind of, our consciousnus isn't necessarily just about what we see, but it's actually some of those, indirect implications. So, who's servicing who throughout from, for us, it's from, farmer through producer, through retailer to us, or, so looking all the way through that supply chain helps you to understand where some of those challenges might be faced, because it's not necessarily the direct supplier that might have access to cash as being a challenge, but a couple of other people down the chain.
Okay, Frederic. One of the things that is actually in the headline for this particular session is that there's reportedly a 1.5 trillion gap between supply and demand for supply chain finance or trade finance in global terms. Now, obviously, that's a gigantic number. Yeah? I'm just wondering, maybe it's just a marketing number for all I know, but it's a big number one way or the other. Yeah. But what's curious, I think, about that is that because there's not enough liquidity around, or is that because the risk of giving that $1.5 trillion to whoever needs it would be too great, or are there other process issues either on the funder side or on the buyer side which are maintaining that gap, or is it a mix of all these things?
Yeah, thank you. I think I can take liquidity first, because I don't believe liquidity as such is a major issue. Just a few days ago, I was discussing with an asset manager, and they are growing their presence in, I would say, receivable business, whatever it looks like, receivable business. And they have raised $1 billion in just 3 months. So, and they are not alone. So now what they're looking for is just a way to employ these funds and just deploy all that money that has been streaming through them. So liquidity is probably not an issue. And we've seldom seen any of our clients say we've got a liquidity issue as such, as in there's no liquidity in the market because banks are not lending or I cannot find anybody. After that, when they are distressed corporates, that's another story, but it's not a matter of liquidity as such. What we're seeing in terms of processes is more interesting because there's two aspects for us. As an insurer, linking up to a platform or linking up to a bank or linking up to a long-term client and making the investment and having APIs or whatever other system to link up or underwriting tool, for instance, with their accounting ledger is not an issue. That's fairly easy. It doesn't mean it's done overnight, but that's fairly easy. We've done it in the past. We'll continue to do it, and we continue to invest in that. In terms of processes, what is important is probably two things from our side: is making sure that we provide the information that is the most up to date as possible, because we are in an unknown environment. So web crawling, artificial intelligence, anything which helps us to have up-to-date information would make a significant difference in the way we can assess risk and thus provide cover. And with cover, usually banks or platforms find it easier to get. So it's having that up-to-date information which is really critical for us. And that's where technology can play a role. We cannot just wait for the accounts of a company to be lodged on Companies House 12 months after the end of the year before we take a decision. So something else has to come into play. And the other thing is, once we've got the information, how fast are we? And that's where, again, algorithms and all the rest play a big role. Over the last 4 years alone, the percentage of auto decisions, if you will, has increased by 50% for us. So now at group level, across the globe, nearly 50% of all decisions which we take are automated. There's no human intervention. Human intervention comes if there's a rejection and then there's an appeal and all that. But other than that, it's instantaneous decision making from our side on 50% of all the decisions we take. So processes is probably not a major issue as such, but there are still some gripping aspects here or there. Probably upstream, not necessarily in the credit insurance world, but upstream. Where we find probably some constraints is in terms of capacity, in terms of risk underwriting, because obviously we have to take into account the changing environment, and there is a level of reduction of cover across all insurers, I would say worldwide. As far as I can judge, we're talking about far less than 10% of the initial exposure. So there is a level of reduction. It does not affect all sectors in the same way. It does not affect all clients in the same way. And obviously, Maurice alluded to it. Some sectors are doing great. Others are really in the doldrums, and clients are affected differently. But there is a form of contraction of capacity, but it's not huge, to be fair, if you look at the big numbers.
And Maurice, what are you seeing in the market in the last 3 or 4 months on this point?
So look, I mean, I think in some ways on the liquidity point, it's early to tell because, requirements for working capital have just collapsed because sales have collapsed in so many different industry segments. So you've seen that, right, play out as line utilization's gone down, and then banks and insurers have cut down risk because it's not in demand, right? So it's prudent to do so. The question will be once the extent of the pandemic and its impact on corporate balance sheets and underlying credit becomes clear, what does that do for the requirement to fund the increase in sales that needs to snap back from any of these sectors on a kind of go forward basis? So I think short term, you've got some really tactical, tactical points that need to play out as we go through the cycle. And we are starting to see reverse inquiry from private credit funds, insurers who anticipate this and want to take advantage of it because they think it'll translate into price opportunity, right? And that really varies, by jurisdiction. So in Europe, you have a very well-performing and mature factoring industry that's been through this before. And so, I would expect that to be able to kind of recover and play its role. In other jurisdictions, you don't. And so we're seeing quite a lot of interest in the North American markets of funds who are seeing, kind of an opportunity to deploy capital over the next 12, 24 months. The other point that I'd make is, this crisis, I think, is going to reinforce the role that banks play and have to play in the market, right? Because this is still a market from a funding perspective that is overwhelmingly bank dominated, and the importance of stability of funding through a crisis is not lost, I don't think, on corporate treasurers or on anybody. And we heard stories of corporates that were working with other platforms who had non-bank funders come on to buy receivables on almost a transactional basis, where the cost went from equivalent L+2 to L+6. Well, surprise, surprise, they stopped selling. Whereas, making sure that you've got reliable long-term relationships with your liquidity provider becomes more important. So I think, the overall gap is solved through a combination of things: better processes, better technology, new entrants to the market, which is healthy, and investment, because this has been a relatively underinvested segment, I think, from a technology perspective, which is why you've got more platforms kind of starting to emerge to take advantage of it.
And Merisa, is that consistent with what you're saying as well?
Yeah, and as I mentioned, we listen to corporates tell their story, and again, I don't think there's a one-size-fits-all. So probably, Richard, when he's implementing his supply chain finance programs, he's got these 3 goals, or these are his key drivers. It could be a completely different story for another corporate. I think liquidity is I think less of a driver when it comes to working capital type solutions, especially if you're talking about supply chain finance programs. We see a lot more companies looking at not only their own working capital needs, but those of their suppliers, and also the whole supply chain stability point that I mentioned. That's really critical now, and it seems like a big driver of why companies are seeking these solutions, and it is an alternative form of financing. So it's good to explore all the solutions you can. Yeah.
I think one thing that'll be interesting as well coming out of this is the banks. Because banks became less global through the last downturn. Undoubtedly, they kind of pulled back. And my sense is that has kind of continued, with some exceptions, and there are some, more globally oriented players. But what happens next, right? Does that continue to play out in that direction? Because that causes an issue for, for programs with companies that have international requirements.
Mm-hmm. Frederic.
Yeah, I think one of the points which explains why banks are retracting as well, and I completely agree with Maurice, is regulations.
Yeah.
We seldom mention that, but in the background, there is this overarching regulation framework, which is heavier by the day. And that forces banks out of some businesses, even if they think it may be profitable, it's just the cost of running a business, compliance and all that, it has become very, very severe. So until regulations start to change, or until the balance starts to move a bit, I don't think banks will be able to come back into some of the space which they have vacated.
Richard?
I was just going to pick up on the points made around kind of cost of funding, and also kind of banks' entry into the market, kind of combined with a kind of a commercial relationship. So I think here the point that was made around having a consistent kind of funding stream, during kind of good times and tough times, is something that I think a corporate and a kind of a treasurer would view as very important. And so therefore continuing to have that stream, and also inviting banks to be part of what would be ancillary business, is also something that can be reasonably expected. It has to be a kind of a holistic relationship, as opposed to just on a transaction by transaction basis, which you then kind of end up with a whole ream of different banks and financial institutions and having to manage those relationships. So I think there's a bank relationship part to play in this, which I would imagine the experience from a number of different corporates will be hugely divergent after this pandemic. However, the relationships between them and their banks, particularly if their banks have been very supportive through this, is one that can stand this test of time, particularly in relation to processes such as this.
And Maurice, I'm just wondering, in a case where at least many, if not all, banks are being a little bit more risk averse, how does that play then to the platformer's idea, which is usually more multi-funder rather than single funder?
We when we talk to our kind of corporate partners, we try and influence the outcome to the extent we can, and so what works best for them. So we're working on an assignment at the moment where the corporate came to us and said, look, we just want to work with our banks, but we need help because we're a small treasury team, and therefore we want to take advantage of the resource you can deploy, some of the expertise in the platform to onboard 2 to 3 of our banks into a trade receivable securitization. So help us work with that. And so our response isn't, no, you should go and, speak to people you don't know, because if anything, banks are telling us across the board, we're prioritizing the relationships we have. Equally, we've had a mandate awarded on the basis that they're just full on, it's a substantial company, but they're full on, their banks are full on their risks. So they specifically want non-banks. And that's taken us down the route of, looking for new funders. So to Marisa's point, every story is different, but there are some themes that run through. And I think platforms need to accommodate what are in the
Right, should I just fill in? But Maurice was talking about this is a nice segue whilst he comes back.
Not what is in the perceived interest of the platform.
Go ahead, Richard. Go ahead.
Go for it, Richard.
Okay. No, I was trying to cover any kind of gaps, Maurice, by just saying I think the beauty of a kind of a multi-funder kind of approach is it does allow for these different situations. So to the extent that your one or several of your banks are full on risk, it allows kind of ease of operation to bring other people into the mix. But also if they're not, then it allows for kind of ease of allocation between one bank and another without necessarily having to get into the conversations about, well, what if you have kind of one bank as a primary lead with their kind of technology solution? You then have to get into the bank to bank kind of discussions around kind of allocation of wallet, which is not going to be in anybody's particular kind of favor.
Yeah, and I have to totally agree with you, Richard. I mean, everyone I've spoken to over many years on this subject, that's always a point of nervousness to say, I want to set up a structure that's actually going to have some longevity about it. I don't want to be chopping and changing every 5 minutes, because if this becomes a core part of the capital structure of the way I run my company, I want to have a level of stability and certainty about that as much as I can. Exactly,
and also, one point of contact I think is always important. You might necessarily kind of keep the relationships with all the banks, or whether they be your house banks or financial institutions that you brought in for a specific reason. You might maintain your kind of relationship with them outside of the platform, but nonetheless, you've still got one point of contact, be it platform in the center to help you facilitate that role.
Okay, I'm going to move on, because one of the key questions here is the role of technology itself. Now, we've seen this in many other spheres. Take the Zoom revolution as an example, where technologies maybe that were there already have vastly accelerated their usage in recent months because of people's changed behaviors or changed requirements. I'm wondering in this space, because we have lots of things that people talk about like blockchain and AI and stuff that we can weave into all this kind of thing. Are we seeing those things having more of an influence now and accelerating, or are they just carry on the trajectory that they were at the start of the year? I wonder, maybe Merisa, if you want to start on that one.
Yeah. And then, I mean, speaking of tech and fintech, a good part of my job when I'm not talking to customers is actually listening and hearing pitches from tech and fintech partners. Because one thing that I can't speak on behalf of all banks, but definitely where I work, we're really open to partnerships. And we want the best journeys, we want the best solutions for our clients. And if that's through a partnership, then fine. But we really grill them on, what kind of pain points are you trying to solve for? Because we never like a solution where the tech or fintech provider is all about their product. Their product is great. Look at all these 250 feature functionalities. It has to be about solving a corporate's, our clients, top 3 goals, key needs, really key pain points. And AI, great. Blockchain is interesting and where it might go in the next couple of years. But if you're talking about what's really exciting about now, the now and what's really happening now, and from what I've seen, I think my favorite technology is API. And we've been able to, for example, take one of our innovation projects. It was just an idea. The project name is Instant Visibility. It was an idea at the end of Feb. We had a workshop about it. We had all these sessions with clients. They loved it, right? And they said they helped us design and co-create this thing. And we're just about to launch something in just a number of months. And we would not have been able to do that without API, web app, and a really good workflow tool. So things like that, they're I guess two buckets. There are solutions where you have to invest in the tech. You have to see what's happening there, because maybe over the next few years something is going to change. But something like blockchain requires the network effect. So we definitely are, listening to what's happening in the space. There's so many. There's Congo, Marco Polo. There's WeTrade. There's Halo Trade. There's a lot of initiatives out there, and we are interested in it. But as and when it takes off, as and when it delivers value to our clients. And then there's the other set of technologies like SaaS we talked about, robotics process automation, things like e-signatures, really quite basic things. That public key cryptography, for example, that's a really interesting one. These are just technologies, is just a way of getting somewhere, and it's really about solving the pain points. And so it's about human-centered design, and you've got technology, and when it's a 50-50 together, then I think a lot of the magic happens. I don't know what you think, Maurice, about blockchain and the likes of AI.
Look,
But yeah,
to your point, people don't come to us and ask for blockchain or AI. They ask us for better syndication tools. They ask us for a better user experience, right? Clearer user interfaces. And they want the deployment of programs to be quicker and more efficient. And to solve that, there are a lot of existing technologies that can be deployed to achieve those outcomes. So we deploy a lot of different technologies. Some of them are traditional, and some of them, a little bit more groundbreaking. But it's what you're trying to solve for that I think will kind of, give you happy customers. So speed and user experience, and behind that, those two particular buzzwords, blockchain and and artificial intelligence, don't really speak to those challenges. So I think if we can use using the cloud, I mean, we are cloud-based, everything we do is in the cloud, that gives huge advantage to clients. It means we can spin up, we can get deals faster, live faster, we can put products into banks faster, and we can provide better service in terms of monitoring them, better infosec, better, so there's so much you can get out of public cloud, right, which has been around for quite a while, and itself requires interaction with different technologies. So we're much more, I know it's it's what everyone says, we're all solution driven, but we're certainly less driven by any individual underlying technology as a source to kind of solve customer problems.
Okay.
When we talk about customer problems, it's what do you, in Treasury, what do you spend a lot of your day job doing, which isn't really value added? It might be it's repetitive tasks or so on. What frustrates you about how you have to, run a program or the day job, and can technology help with that? So I really see there's a lot of application where you can use technology or machines to do the ordinary stuff, so that the people can start doing the extraordinary, the value add. And as Maurice said, a lot of this technology is available in now, and it's less about it's definitely about simplifying. It has to be simple, easy to use, quick to use. People's attention spans have really shrunk these days, so you have to get things across very simply, easy. A few clicks and you're through. You have to remove the friction, and I think that's what our clients keep saying. Just make my life easier. Let me spend less time on mundane things. I want to reach out to 1,000 suppliers. How can that be easier for me? And how can they listen to an easy message about what it is we're trying to invite them to?
And I just wonder, just following on that point, Merisa, that probably for Richard this one, there does seem to be a tendency that Treasury departments are getting smaller, not bigger. And it's great that all these technologies are around and available, but it must be a considerable strain to go and implement anything when you don't have lots of hands to go and do that implementation.
Yep. Yeah.
I mean, you're in the middle of implementing a solution right now. I'm just wondering, from the point of view of resource, what's the pain from your perspective?
It's not easy, Brian. I think particularly during lockdown, right? I mean, I think just kind of touching on the last question about kind of blockchain and AI. I think that, and maybe kind of aligning it with the idea of kind of resource is. It is about kind of what's simple, and also about can we as treasurers or just as people kind of explain it easily, because actually if we can't explain it easily, we can't understand it, therefore it's not going to get the buy-in of kind of our internal management. So whilst I understand the concepts of blockchain and AI, I totally agree with kind of Maurice and also Merisa that there's a bunch of things out there that are prevalent now and available to us that we're probably just not kind of reaping the benefits of now. In terms of implementation, I think it's a challenge, and a challenge not to be underestimated. I think, you know, in terms of, I mean, this is any kind of change management process that I'm sure everybody kind of watching will kind of share some form of pain around. I think in terms of inputting the supply chain finance piece, and as you said, we're yet to go live, but we've kind of, there have been some easy kind of aspects. I mean, I think on the face of it, IT connectivity should be an easy thing relating to kind of interfaces, yet actually getting the two systems to kind of talk to each other, you know, requires an element of kind of testing and a lot of focus from the people that are involved. I think because I think setting out on that kind of journey, I think it's always a suggestion for us to try and take a kind of a manual process up front and then address it in the medium term. And I think we kind of chatted that actually any kind of short-term solution generally becomes a medium-term one, because the intention isn't necessarily to come back and revisit in the future once the benefits have been realised. I think it's a time thing. I think there has to be a kind of a clear goal and a priority for what we're seeking to resolve. And then, you know, challenges will come, right? I mean, I think it's inevitable with smaller treasury teams that you need to look outside of that treasury team for some of the expertise and to work people in a true kind of multi-departmental project, as opposed to it just being treasury led and treasury owned, in which case you're probably not going to get the benefits out of it.
I wonder if another challenge is that very often treasurers are seen by their CFOs as the money guy. Yeah. So when I need something that's going to produce cash or conserve cash, I'm coming to you. But if you take supply chain finance as an example, you know, my experience is to implement that requires a very cross-functional approach. And then the challenge for treasuries, you know what the outcome, that you want to happen, but you don't actually control the processes that will make it happen.
No, and that's tricky. So, and it's horses for courses, isn't it? You know, because actually, whether it's buyer, it's kind of seller led. If you're looking for a kind of a vast inflow of cash, you know, in order to support some liquidity need, then supply chain finance probably isn't the tool for you. If you're looking for kind of, you know, structural support of your supply chain, then maybe that is the tool. But you're right in the sense of actually who do you need. If you identify who it is that you need in order to make this project, you know, real and successful, you're going to need your procurement team, because they are the ultimate ones that will earn that sell to that kind of supplier. You're going to need your IT team. You're going to need your project team. You're going to need kind of people across the board, particularly where something like this, that I would argue is probably more difficult than just raising general finance, because there are many more kind of moving parts than simply speaking to a bank or raising some debt.
Just changing tack a little bit, Frederic. I'm just wondering. I mean, this must be certainly a change point, if not a level of trauma for the credit insurance industry in terms of, you know, what either has happened or could happen. I'm just wondering, you know, what's changed for you guys in the last 3 or 4 months?
Well, that's what we can see, and what we can see today already is a surge in the number of claims notifications. So by numbers, it's gone up by really big amounts. By values, we're talking something different. And what's interesting is that there's been no big collapse. I mean, we're a few airlines here and there, a few companies, a few traders around the globe, but there's been no major collapse that has literally rocked the industry in the same way, for instance, as last year we had Thomas Cook, which cost a lot to the industry and generally across the financial industry. So it's not so much the big tickets that are hurting us, it's the frequency. And the most interesting thing is that most of these are non-payments. They are not insolvencies, straight insolvencies. It doesn't mean that we will not indemnify, and at some point we'll end up in insolvencies, but the overwhelming majority of what we receive, and much more than in the past, is just non-payment. Companies sitting on their cash, not paying their suppliers, and for some of them, it will be a definitive, we're not paying and we will not be able to pay. And for others, it's a matter of trying to collect out and finding a way to collect out, which is also made more difficult currently by a number of changes in legislation across Europe and probably even beyond Europe. And so we are in this situation where we've got a lot of debt outstanding, and we don't know if it's a genuine cash crisis where a company will go bust, or if it's just sitting on the cash and paying later on. So in order to take action, we need to know as much as possible, because the last thing we want to do is take a scattergun approach whereby we're saying, oh, we've got risks galore, let's take out risks, because otherwise we would be out of business in 6 months. So that's where we're back to the notion of how can we have the most up-to-date information? How can we make sure that we understand where not only sectors, but individual companies are in, and what level of stress do they feel? How long can they withstand the current situation? We've seen some announcements by major corporates about how much they had drawn on their RCFs, how much their liquidity had gone up. But at the same time, they were saying they would lose billions of cash during 2020. So the question mark is, how long can they withstand that kind of pressure? And it's all a matter of having the very latest information and being sure we're on top of things here.
I mean, certainly what I'm seeing at the moment in terms of payment performance on both sides of the fence, both the buyer and the seller, it's a very mixed picture. There are certainly pockets, like, I don't know, the restaurant industry, who've just basically shut down, who can't pay anybody. So we have sectors like that, or the airline industry, who are trying to not pay refunds to people because they don't have the cash and so on. But equally, I see there's people at the other end of the scale. I mean, I'm sure, Richard, you're saying this with many of your supermarket customers, who are actually being quite generous from a point of view of cash because they have lots of it at the moment. And they're one of the winners in this whole scenario. And probably I see there's most companies, they're suffering a little bit, and they're also seeing some advantage a little bit too. But it's kind of a mixed bag for the vast majority of companies. I imagine, Richard, this is probably true for you because you don't just serve supermarkets, you serve lots of other sectors as well, who will invariably perform very differently through this kind of crisis. And then the question, and I don't know the answer to this, is that are these a permanent set of changes that we're seeing, or do we get to September, October, and all snaps back some way to the way it was? I don't really think that's going to happen, but I have no idea to the extent it might happen. What do you think, Richard?
I think the only thing that's certain is the uncertainty, right? I mean, I don't think anybody actually knows. I mean, I think picking up on what kind of Frederic said, actually, the importance here in the sense of kind of credit insurance market is, given the preponderance of credit insurance in general across all of our kind of supplier bases, actually, if we start withdrawing credit insurance because there is a systemic, consideration of risk, actually, then that prompts a lot of everybody's suppliers to try and to lower down their internal credit limits and call for their cash early, which almost kind of creates a liquidity crunch. In terms of payment performance, I think it's back to our point that says this pandemic is it's very dislocated, isn't it? It's very much down to that kind of individual sector, or indeed that individual company within a sector that's having a very different experience. We're obviously having a kind of a fairly good COVID experience, but also kind of humble with it, in the sense of it might not necessarily be the company itself, but actually part of that kind of supply chain that causes a knock-on impact. But certainly, it's both a practical example, but also one that's been well publicized, that if you look at the retail sector actually advancing some of their payments as they seek to look at the structure of their supply chain, is something that is taken as being a great benefit to everyone. Yeah. What happens in 3-4 months' time?
Something else that kind of crossed my mind is, around kind of speed of implementation of solutions. Yeah, Many years ago, I worked for, I'm old enough to remember a company called Wang Computers, yeah. And Dr. Wang, who was the boss of this, an extremely charismatic gentleman, yeah. And his slogan that he used to tell everybody was speed over accuracy, because he was terrified that the technology would be out of date by the time they got to implement anything. Unfortunately, this is the same reason why the company doesn't exist anymore. And I wonder, Maurice, talking about the speed of implementations. I mean, I had one platform provider, should be said, not your guys, yeah, who said, "Oh, we can have our first supplier up and running within 3 days," yeah. And I must admit, I was kind of thinking, wow, that sounds a little bit too good to be true. I mean, one, is that really possible? And if it is, just what risk are you taking on board by doing it that quickly?
I think on putting, obviously, they've got better sales guys than we do, because we talk about being able to stand up a program in 4 to 6, in 4 to 6 weeks, if everything goes according to plan, right? Which is obviously, so I suppose if you're using it as a proviso, you can say we can have it done tomorrow if everything goes according to plan. Of course, it never does. So it's about the readiness of the platform provider and of the corporate to and the funders to be able to stand up a program. And there, I think there's a lot of opportunity to continue to drive efficiency and get down to a real kind of 4 to 6 week process. If we look at some of our mature bank platforms who use our platform, they're able to do it in that time frame. So, I think that there are lots of reasons that will drive successful penetration of a program, and making sure that all parties are ready for it, that you've got the appropriate level of resource deployed, is as important as anything else. And I think it's also, there are a range of different supply chain finance solutions that are available in order to, drive different objectives. So whether it's a simpler factoring type arrangement, or a trade receivables securitization at the other end, or a supply chain finance solution, all of them have their own dynamic. I do think, looking forward, when you're able to stand up programs on one platform, right, with one product team that can support those product variants, which isn't really the case today because the market is still quite siloed, you'll have a lot more efficiency. And integration with credit insurers in the way that Frederic's outlined. There are lots of things that will change over the next over the next 2 to 3 years that will make it faster, more efficient, more predictable, and the platforms will get more mature, right? I mean, you look at the scale of any of the platforms in the market today, and we're one of the biggest. You're still at a relatively early stage in their kind of corporate life cycle. So I think it gets faster, and it gets faster for a range of different reasons.
I think the question to ask is why, right? Or are you just chasing speed because that's probably not the right driver? Is it just because we can say 3 days, we can do 3 days, that's great. But why do you need a program up and running so quickly? Is it for supply chain stability? And if it is it for a handful of suppliers? They're really critical and they're suffering right now and they need something in 10 days, in 20 days time, then we can look at that need and see what's the best fit solution for that. Or is it because you need to have something launched to your entire supplier base and you just want to make it known that you're there to support? And does it have to be in 10 days, or could it be in 6 to 8 weeks and done properly? So these are the questions to really get down to the root cause. And I would really caution against doing something just because you want to be the fastest, the quickest.
Especially because these programs are in place for so long. I mean, the benefit, right? They have high barriers to implement for the reasons that Richard kind of expanded on and others. But once they're up and running, they become a structural source of funding for everybody involved, and they typically, stay the course. So I completely agree, Merisa, get it done properly and as fast as possible, right? Rather than speed for speed's sake.
Like Maurice said, that there are other solutions, discounting promissory notes or so on, that you could look into if you had that real need for something really quickly. But yeah, get it done properly.
Sorry, Richard, you were going to say something.
No, I was just going to agree, to be honest. I think it's about purpose, as Marissa said. What is the issue you're trying to solve? And therefore is the program that you're seeking to implement going to resolve that? And therefore you can consider, timeliness of doing it I think it would probably be, granted, so our implementation is going on through lockdown, which has its own sense of challenge attached to it. But I think there's a question about automation. You can put in a program which has a lesser degree of automation and probably do it quicker, but then you are kind of sacrificing short-term, gain for a kind of a long-term pain, as actually it becomes an inefficient thing that works through your, ways of working. But then I don't think anyone should underestimate the internal will that's required in order to get these processes and programs implemented. Well, I think Maurice is, and as you clearly kind of said, it's about, you can do things in a short period of time, providing all things nicely match off as part of the same process, which involves all your internal resource being in the right place at the right time, no one taking holidays and all of those good things, which is a factor of life, right?
Well, one of the things I was told years ago, I think it's called the Carpenter's rule, that you measure twice and you cut once,
Yes,
and hopefully not the other way around, and that by taking that little bit of extra time and being careful and going into a little bit more detail about it, then it's more likely that you're going to avoid the mistakes that you'll probably make if you just go at the thing way too quickly, And as Maurice, you say, absolutely rightly, whatever it is you do, right or wrong, is something that you're going to be stuck with for a long period into the future. So it is actually worth getting it right, isn't it?
I always say, if I ever write a book, and I won't, because no one would be interested in reading my story, but if I were, it would be called "It Cost More and It Took Longer." So if that's true for everything, then get it right? Because that has to be your outcome.
That sounds like a government project somewhere, doesn't it?
Yeah, exactly.
Okay. Well, listen, we've got some questions from the audience. Yeah, a bit varied, this. One is about ESG credentials and, how much they're having an influence in funding these kinds of solutions. Richard, it's probably closer to you. Might not be a factor for you guys at all. I don't know.
I from a personal perspective, not so much. I think, from a wider kind of funding and appetite of different, potential funders in the future, I can absolutely see that as people kind of focus a little bit more upon, investments and allocation of capital that has an ESG kind of angle to it. So I can see that coming down the chain. Do I see it kind of directly and particularly from a personal perspective? No, not really now. I think it's certainly incumbent on every kind of corporate to focus on that as part of their wider plans.
Merisa?
Yeah, so ESG or sustainability, it definitely comes up in a lot of the discussions we have with corporates, and it's really interesting in how it could work with working capital solutions. And we've got some companies who say, you know what, if you can differentiate, for example, the pricing of a supply chain finance program and give benefit to those who are better at ESG scoring, and then we have to talk about what's the best way to measure that, because it has to be the right way of measuring it, then that's fine. But then I've also talked to other corporates who said, actually, I want to be fair to my supplier base, and I want transparent pricing. So it could potentially, you could look at supply chain finance programs as a way to incentivize potentially sustainable behavior and so on. That's a really interesting area. And I would say no one size fits all. But if you've got the right kind of platform tool in place, and it depends what your goals are, it's with the right technology, you can really structure something very interesting.
Maurice?
Yeah, so we've been doing quite a lot of work with the IFC, who are one of our shareholders and partners, because they have the ability to implement and fund programs based on the EHG, the sustainability criteria they assign to the suppliers, and they focus on emerging markets. So it's a
very interesting point.
Shall I try and do another segue?
Go on, Richard.
All I was going to do, I was going to pick up
of theirs, and it can bring significant benefits.
Sorry, it froze again there, Maurice.
No, go for it, Richard. You see, I can shut up altogether.
No, that's all. I'm just filling in, I think, Maurice. I was just going to pick up on what Merisa said about differentiation in cost of funding, which I think is kind of a wider implication for the market. You know, to the extent that actually you can differentiate in cost of funding attached to any kind of funding solution based upon ESG or kind of sustainability credentials, then I think then you've got a structural change across the market, because then so many more people will have a different appetite for it.
And I wonder, just kind of stretching this point a little bit, if we talk about the cost of funding, if a supplier is deemed to be, shall we say, an ethical supplier, and you can debate what an ethical supplier actually is that better from the point of view of risk and pricing for risk, or does it make any difference at all?
I think that's still up for debate.
Personally, I've never seen it make a difference yet, although I'm sure there's a lot of people out there who would like it to make a difference. Yeah.
As I say, I don't know how much I was talking on my own, but for the supranationals who are focused on different outcomes for their customers, or for emerging market suppliers, it makes a difference because that's how they're measured. But I'm not sure it's the same in the commercial banking space.
Okay.
If you think very, very long term down the road, in 50 years' time, if you've got a supplier who's just doing all sorts of bad things, that can't be sustainable, and you can't imagine that might continue for that long a time. I think the challenge we have is we don't have the data yet to prove any of this, and a lot of it is forward looking, whereas a lot of our data is backwards looking. So
I think also we've seen, like the case with Goya in the States at the moment. I mean, consumers can change behaviors both positively and negatively extremely quickly, based on these things. So it's very unpredictable too, isn't it? Here's another. It's probably a very quick one. Yeah, I think I know the answer to this. It's about blockchain. Yeah. Question is this just a solution looking for a problem? Please, Frederic.
I can try at least one answer, because 3 years ago I had dinner with one leading member of a bank, and he said, with blockchain, we might end up knowing the sellers and the buyers in all the transactions worldwide. Okay, not worldwide, but at least amongst a number of banks, and we will remove seeding risk, or we will remove dilution risk, and we will be able to fund a lot more. Okay, that was 3 years ago. I'm not sure they are much more advanced than they were at this point in time, but the principle is a very good one, to say you remove a major risk, which is actually the number one risk for financing invoices. You release part of that 1.5 trillion of funding gap. But again, I'm not sure we've made headway on that.
Okay.
So in theory, yes.
Yeah, I tend to agree with you, Frederic. It's one of these things that it's the next great hope, isn't it? And we've seen many of these false dawns on lots of different subjects. But it's still a good technology. It's just, what are we actually going to use it for? Yeah,
it's a technology, and it comes secondary, because you have to see the primary driver. And every time we discuss one of the blockchain initiatives, we just ask, well, what pain point are you trying to solve for? What's the use case, and why? And some of them are good ones, but you don't start with blockchain and then try to figure out how you're going to use it.
It reminds me of the .com bubble, when there was all kind of feedmydog.com automatic and so on. Things that seemed like a good idea to someone, and they never survived at all because no one needed it. It seems just another version of these kinds of things.
There have been applications, right? So Bitcoin has been surprisingly robust, right? And so some people say that this is the alternative kind of store of value in a world where governments are going to overstretch themselves and so on, and that continues. It's just hard. We haven't yet found its application in trade. So I think the early attempts just haven't shown traction yet.
Okay. Very final question, because we're running out of time. As the crisis accelerated more technology adoption, is there more technology adoption within Treasury? And if so, what areas are being prioritized? If I give that to you, Maurice. You're the technology person here.
I am, but I'm not the treasurer, so I'll defer quickly to Richard, and certainly in case I cut out again. But I mean, I think everyone's looking to use technology to drive efficiency. And so, in our world, which is squarely focused on supply chain finance products, driving adoption in order to make things easier and accommodate multi-funder, that's very appealing to treasurers, especially treasurers who are suffering from particular pain points. So we often get calls from people saying, look, this facility is just not working. So can you help? Will a platform help solve that issue? So I think the answer is yes, but I'll defer to Richard.
Okay, Richard, last word.
All I would say is I think one of the kind of the outputs of the pandemic is to highlight some inefficiencies in process that sometimes can be, fluffed over when you're in the office. And so now, everyone's working dislocated, and so therefore that highlights that actually maybe a focus on technology would help to alleviate some of those pain points, but that's across the board, whether trade finance or just as part of your general day-to-day working. I think refocusing upon technology, and as Merisa said kind of early, those solutions are already available for you. It's just about the willingness to use them and also now implement them in a lockdown environment.
And Merisa, very quickly, yeah.
Just wanted to add, technology is not scary, and it's not, you don't just look at the big transformational things. Small things like, workflow tools, having Microsoft Teams and getting it rolled out across the organization, 365, it's just changed the way we do things. And just think about things that you're doing on spreadsheets a lot, or all these manual things. There are tools out there to really transform the day-to-day, and that gets really exciting, and hopefully companies have had a chance to use the pandemic as a way to look into those kind of tools and get people working collaboratively from home. I've seen people editing the same thing, 6 people at the same time. It's pretty phenomenal, and I'm not going back. So yeah, it's I think Teams, for example, is something that's so easy to use. And then for those who are more technical, you can use Confluence or Jira. These tools are out there.
Sure. Well, on that note, thank you, Merisa. Thank you, Maurice. Thank you, Richard. Thank you, Frederic. Yeah, I think that was a very good discussion. I even learned a few things, which is always good. I'm sure, I hope our audience has as well. And thank you to them for joining us. Just a reminder to our audience, there's still feedback surveys that you can fill in. There's still the discussion forum, which goes on after this. And also remember that if you miss something in the session, they are recorded. You can go back and have a look later. So, and they'll be available, I understand, at some point later today, but I'll get told off for that if that was too quick. In the meantime, thank you very much, firstly to our panel, to our audience, and thank you for listening and watching. Thank you.
Thank you.
Thank you.